The debt ceiling is a limit on the total amount of government borrowing. It was first put in place by Congress during World War I, and it has been raised 78 times since 1960. The debt ceiling was last raised in 2021 to $31.4 trillion, where it currently stands. The government borrows money to pay for its expenses, such as Social Security, Medicare, and military salaries. But almost every year, the government spends more than it collects in taxes. This creates a deficit, which adds up to the national debt over time. The national debt is now over $31 trillion. The debt ceiling was paused by the U.S. Congress in 2021 as part of a bipartisan budget deal that suspended the limit until December 31, 2022. This allowed the government to borrow as much as needed to cover its spending during the COVID-19 pandemic and its economic fallout. However, the debt ceiling pause expired at the end of 2022, and the government has reached its borrowing limit again. The Treasury Department is now using accounting tricks to avoid defaulting on its obligations, but these measures will only last for a few months. If Congress does not raise the debt ceiling soon, the government will run out of money and default on its loans. This would cause severe damage to the U.S. economy and global financial stability. It could also lower the U.S. credit rating, making it more expensive for the government to borrow money in the future. The reason why Congress has not raised the debt ceiling yet is because of political disagreement. Republicans, who have a majority in the House, want to use the debt ceiling as a leverage to negotiate spending cuts. They argue that increasing the debt ceiling without changing the government's spending behavior would bankrupt the country and its entitlement programs. Democrats, who have a majority in the Senate and control the White House, want to raise the debt ceiling without any conditions. They argue that failing to do so would jeopardize the economic recovery and hurt millions of Americans who rely on government services. The two parties are locked in a standoff over the debt ceiling, with no clear resolution in sight. The clock is ticking, and time is running out for them to reach a compromise before it is too late. The debt ceiling is a legal limit on how much the U.S. government can borrow to pay its bills. It was suspended in 2021 until July 31, 2023, but Congress has not yet agreed on raising or suspending it again. This means that the Treasury Department will soon run out of cash and extraordinary measures to keep paying its obligations. One of the obligations that the Treasury has to pay is the interest on its debt, which is mostly issued in the form of Treasury bonds. These bonds are considered the safest and most liquid assets in the world, and they are used by investors, banks, central banks, and other governments as a store of value and a benchmark for interest rates. However, the uncertainty over the debt ceiling has created a disruption in the Treasury bond market, especially for the short-term bonds that mature around the time of the potential default. Investors are flocking to one-month bills that mature before June 1st, driving their yields down to near zero. On the other hand, they are shunning bills that mature after June 1st, driving their yields up to unusually high levels. This inversion of the yield curve reflects the fear that the Treasury might not be able to pay back its creditors on time if the debt ceiling is breached. This could have severe consequences for the U.S. and global economy, as it could trigger a spike in borrowing costs, a loss of confidence in the dollar, a sell-off in other assets, and a credit rating downgrade. The Treasury Secretary Janet Yellen has warned that failing to raise or suspend the debt ceiling would be catastrophic, and urged Congress to act as soon as possible. She has also said that she does not have the legal authority to prioritize interest payments over other obligations, such as Social Security benefits, Medicare payments, military salaries, and tax refunds. If the debt limit binds, and Treasury were to make interest payments, then other outlays will have to be cut in an average month by about 25%. That would be necessary because the Congressional Budget Office expects close to 25 cents of every dollar of non-interest outlays to be financed by borrowing in 2023. This would mean a sudden and massive fiscal contraction that would hurt millions of Americans and businesses that rely on government spending and services. It would also undermine the economic recovery from the pandemic and possibly push the country into a recession. Therefore, it is crucial that Congress reaches a bipartisan agreement on raising or suspending the debt ceiling before it is too late. The debt ceiling is not a tool for fiscal discipline or political leverage, but a doomsday machine that could wreak havoc on the U.S. and global economy if it is triggered. The debt ceiling is a limit on how much the government can borrow, set by Congress. The U.S. hit its $31.4 trillion ceiling on January 19, 2023, but the Biden administration and the Republican-led House of Representatives have failed to agree on how to raise it. If the debt ceiling is not lifted by June 1st, the government will run out of cash and default on its obligations, which could trigger a catastrophic economic crisis. One of the obligations that the government has to pay is the interest on its bonds, which are debt instruments that investors buy to lend money to the government. The U.S. Treasury bond market is the largest and most liquid bond market in the world, and it is considered a safe haven for investors who want to preserve their capital and earn a steady income. However, as the debt ceiling deadline approaches, investors are becoming increasingly nervous about the possibility of a default. This has caused the interest rates on short-term Treasury bonds to spike, as investors demand higher returns to hold these risky assets. Higher interest rates mean lower bond prices, so bondholders are losing money as their bonds lose value. The bond market turmoil has spilled over to the stock market and caused a sell-off for several reasons. First, higher interest rates make borrowing more expensive for businesses and consumers, which reduces spending and investment and slows down economic growth. Second, higher interest rates make bonds more attractive relative to stocks, which lowers the demand for stocks and reduces their prices. Third, higher interest rates increase the discount rate that investors use to value future cash flows of companies, which lowers their earnings expectations and stock valuations. Moreover, the stock market is also affected by the uncertainty and fear that a debt ceiling crisis creates. Investors are worried about the potential consequences of a default, such as a credit rating downgrade, a loss of confidence in the US dollar, a disruption of global financial markets, and a deep recession. These worries make investors more risk-averse and more likely to sell their stocks and seek safer assets. In summary, the debt ceiling pause has led to a bond market turmoil that has spilled over to the stock market and caused a sell-off. The stock market is facing both higher interest rates and higher uncertainty, which are negative factors for stock prices. Unless the debt ceiling issue is resolved soon, the stock market could face more volatility and downside risk.